touch on some very important topics that we have here. The most obvious today, which is in the news, is the market has jumped more than, I guess, what, 8% today. Joe, was the final at the bell. Um, that's one of the biggest moves that we've ever seen, and probably will see at least in the next couple of days. And
Yeah, at least for today.
that's the joke. For the moves are happening so quickly. I mean, the speed of the movement of these markets right now is it's unprecedented, but it does lend to the amount of technology that's in place for the trading systems, and if we want to even touch on the person who was short today and had to cover. We will touch a little bit about that. But for now, the president's more aggressive stance on tariffs has taken markets by surprise, and it leads to heightened geopolitical uncertainty, and you have sell-offs, and then you have rapid recoveries. Early actions from the Trump administration signaled that the United States was going to stand pretty steady on uh, uh, re-engaging with the tariffs that would potentially bring revenues back into the United States. We can talk about the dollar and the strength of the dollar today. We will definitely address the deficits, and what our outlook is in reducing the size of the government, and what concerns we have on a potential U.S. recession, as well as rising inflation that's out there. However, this situation is rapidly evolving, and as you saw today with the incredible move with the S&P 500 and the Dow, and even the Nasdaq, everything is really uncertain. And these recent changes in trade and immigration, fiscal policy, and regulation and deregulation are ultimately impacting and affecting the global economy. So the pricing of the market right now, before today, Joe and our notes were that the market's currently pricing in a very negative outcome. But as you saw, Trump put a 90-day moratorium on the tariffs, so people can come to the table and start talking about it. I would like to say that historically, Alex will talk about this steep sell-offs have often been followed by strong rallies. And we can show that from 6 months to 12 months out, we should be in a much better position. And we're looking at the falling interest rates that have improved lending conditions out there. M&A activity is picking up, and valuations as of yesterday and today, they had improved dramatically and are now near the historic averages. And we are an active management firm, as you know. We've been managing money successfully for clients for nearly 25 years, if you date it back to when Bob DeMichael started the firm, and then we took over the management. But I would like to turn over the conversation to Joe, and Alex and I will carry you through what is working and what we see out there. Joe?
Yeah, thank you, Tom, and thank you everyone for listening. A couple of things that we want to touch on, and heading into this year, we did expect to see some volatility, and that was just based on 2024 really not seeing any big wild swings. And then we fast forward to what we've seen in February, March, April, and we're making up for it. And as Tom mentioned, historically, when you get these sell-offs and they just happen to be clustered with Thursday, Friday, and then again on Monday, and then seeing a recovery today, this is not uncommon in our history. And we can look back at 2020, 2020, 2008, and we can see this type of volatility. It's just the speed that is alarming. And one thing that we try to do is not make emotional decisions. And I really think that's what active management is for. And it's to keep people from making decisions based on emotion, not overreact to headline news, and to really follow your financial plan. And these are times that are tough. But it's also when we see these drawdowns, for us, this is where technicals play a big part in how we manage. We are very oversold, or what we call washed out levels. And that just means typically when we're at these levels, you're pretty close to seeing, the worst priced into the stock market. And that gets us to go on. The stock market is a forward indicator. It's looking out 6 months down the road. And that's what our job is to do as well, is to not get caught up on what's happening now, but what's going to happen down the road. And what's been tough with this market, it's on a daily basis, we're getting new information that can potentially change. And then it sets you up for, seeing a relief rally, which we had today. And we do know when you get these steep sell-offs, and then you get a rip-roaring fierce rally, that tends to happen, when the damage has already been done. So, I don't think we're out of the woods yet, but this is encouraging to see that money is coming back into the markets. Now, a couple of things to look at is what you own. And I think this has really played out, and this is going to be a key going forward, is to really look at the portfolio that you have. And where you've really just owned 7 stocks, and that's really helped. And you're forgetting about the other 493 that make up the S&P 500. And I do think that's going to be a return. You're also going to see some global, worldwide strategies. That's working. So we might start seeing, again, other places to be invested and not so passive. And that's been, a trend that has started really this year. And we do think, that is going to happen and continue to happen as this year progresses. But again, I wanted to make sure we've done a great job with letting our clients and our advisors know we weren't being overreactive. We weren't panicking. We still said the economy was in good shape, and jobs were, the level of jobs that we had. You just don't get significant recessions when you have full employment or employment levels where we're at. So those weren't, things that were deteriorating yet, not in what we see. Another thing that we look at is the borrowing costs. And you typically see these big spikes between what we call high good quality and then subprime, which is junk. And it did spike up, but not to panic levels that we've seen before. That just means the market was acting in an orderly fashion. There were no dislocations. Now, another point that we wanted to mention, it's the what ifs, and Tom alluded to this earlier. What if things weren't as bad as what appeared? And what if we do get some agreements going forward? And again, with today's announcement, it's one day, and I'm not saying we're out of the woods, but again, when we get so tuned to one negative outcome, it opens the door for things getting better. And that also happens with the valuation. Now, when things are priced for perfection, you're more susceptible to having drops. And when things aren't priced for perfection, they're more at a lower valuation, that's good. And that's important because the stock market has 10% drawdowns every year and a half. We do get 20% pullbacks. We've seen that, we'll go over the data a little bit later, but these are not uncommon. It just goes to show you balanced accounts are working as well. And that's a reason for fixed income. But getting into some of the specifics, like Tom mentioned, the price of oil, gasoline, think about that. It was in the 70s, and now, we're below 60. So you've had these big movements that are going to help the consumer going forward. Because I know we're getting more electric cars, but I'm still the old school with gas. That does help our pocketbooks. And the same thing with having lower rates. You really think going forward, what does that do? It allows the consumer and also companies to borrow at lower levels. So it's a lot of things that are happening. And prior to today, and Alex will go into this really briefly, after I finished talking. It was looking at the effects of these tariffs. We know the effect that it did in the United States, but remember, we're trying to address our fiscal deficit. We're trying to address some of the government spending that's gone on. And we're seeing other countries that are behind us, they're in far worse situations. And Alex, did you want to elaborate on that?
Yeah, I think it's pretty notable that even though investors were not well prepared for tariffs, importers have been preparing for months. They've stocked up on product, and most importers have, 3 to 4 months worth of goods. And so those businesses that have prepared will not need to overreact in the short term, especially if they think the tariffs won't be permanent, which after today looks very possible. It looks like everyone is going to get a deal except for China. And we're seeing basically a game of geopolitical chicken, but it's asymmetrical. Countries like Canada and China need US trade far more than the US needs to trade with those countries. So even though a trade war would be negative for the US economy, the administration is banking on the fact that it would hurt these foreign countries significantly more. And as a result, they think most of these foreign countries are going to make a deal. That does seem like the likeliest outcome at this point. Of all of the major economies in the world, the US is actually the least exposed to international trade. So in this scenario, America has a lot of leverage. Really, the thing that might stop that is political sentiment. If you look at a place like Canada, even though their economy would be completely crushed by a trade war with the US, Canadians right now, they feel bullied. They don't want to give in. That's an emotional response. It's not practical. At some point, practicality is going to kick in, and they're going to make the deal. Trump has sort of already shown people the stick. Now I think countries will be shown, the carrot. Also, like, even if these tariffs are fully implemented, I think it would be a mistake to assume that it guarantees higher inflation. In 2018, actually, inflation went down after the tariffs were implemented. Now, clearly, that wasn't because of tariffs, but there's hundreds, if not thousands, of factors that drive inflation. It's very, very complex and difficult to predict. So if the tariffs are implemented, right now we, basically have China being tariffed aggressively. We'll need to, watch the data, be nimble, and react.
Joe, let's talk a little bit about the technicals again, and explain with Alex's help what we've been watching for the last several days take shape.
Yeah, and it really stems from February. And if you've been listening to some of the newsletters we put out there, when you get bearish sentiment, this is just one area to track. It's typically you're in the bottoms of the market, so to speak. And what you have to look at is what happens forward. And what we saw, not just with the bearish consumer sentiment, we also saw it with some of the technical indicators we follow. And they got at such oversold levels, it's like a spring ready to bounce back up.
Right.
And we saw that in February, but we really saw it in again with Thursday, Friday, and Monday. So when those levels get so oversold, it's just everything will spring back up. And Friday was really one of those days where everything, if you own stocks, you were down 6% minimum. And what's interesting, it's the mega cap stocks. Again, when you get in a de-risking, you sell, what you own and things that have done the most. You're not really looking at what you should be selling. You're just going to be selling everything. That's the panic selling. And that also happens for people that are on margin. You get a margin call. Again, you don't get to choose what you sell what you own. So those are a few things that we saw. And I do think as we get more clarity, that's when this market can recover. So, you do expect volatility doesn't just go away after one day, but we're going to probably see this for the shorter period. But again, look forward. And when we look at market returns, 6 months, 9 months, 1 year, 2 year, after we've seen this level of deterioration and washed out on the technical side, the markets post really good returns. So I want to also remind people that you have to have some patience in the next short term. But as long as we have full employment, the economy is working, the market is going to look forward, just like we should be doing.
Alex, talk a little bit more about the kind of the technical side of things on from your perspective, and then we're gonna go over to talk more about the deficit. All
Yeah.
right.
These types of sell-offs, I know they seem crazy while you're in them, but it's nothing extraordinary. We basically get one of these volatility events every 2 years, and it's been that way for a decade. We had it in 2015, 2018, 2020, and 2022. So the key for us and for most experienced investors is to stay invested and to not panic. That has been by far the optimal strategy for dealing with these volatility events. Panic is really your enemy. I think there's a lot of investors that have been trading this market exactly wrong, panic selling, then panic buying back. And I think, this particular event, it really reminds me a lot of COVID. If you remember, we had a 30% down month during COVID. There was a ton of fear. There was uncertainty. Nobody had been through a pandemic. Nobody knew what to do. But, we had a call just like this one. We told everybody to stay the course. Things will be fine. And that ultimately proved to be correct. The markets recovered. The economy recovered. And, even on top of that, it's important to remember that tariffs are completely reversible. So even in the absolute worst case scenario that tariffs are implemented and they're somehow a complete disaster for America, they could be, reversed overnight, right? This isn't anything that's going to be permanently impairing the U.S. economy in any way.
Let's talk a little bit about the deficit. Go ahead, Joe. You were going to say something?
It's a good point to remind ourselves, there are periods where things are not going to be rosy. And we remember there was a lost decade for 10 years. The market really didn't do anything. But what we're saying is when we have these headline events, that's different than seeing deterioration in the economy. And that's what the events happen with COVID and now, and why it's a similarity. They can be unwound. We didn't know when the government was going to open up again. We didn't know it was going to happen. And that unknown is different than, going into a depression or something prolonged of a recession. I just wanted to make that clarification.
Right. So, the United States must maintain its leadership role with the global economy. And these, whether the tariffs are viewed as negative or potentially as reshaping the way that business is done, this is a transformative program that's going to take time to have results. And I do want to talk a little bit about the deficit, Joe and Alex, and just putting it into perspective of what needs to be done, and then how are the clients going to benefit from this in the portfolios that we own.
And this is a big known to get to know. It's really the government its job is not to keep funding our country. We've gotten a bigger economy because the government kept expanding. And in our view, the government shouldn't keep expanding with technology. It can get more efficient. It can get smaller. And that helps the consumer. So when we look at the deficit, the 5 largest parts that we spend on, and it's Social Security, Medicare, Medicaid, defense spending, and then interest expense. Those are tough things to tackle, and they do require, all of us to not have as much. So how do you go about spending less there? You have to start somewhere. And we know none of the politicians are ready to give up anything in their constituents. So you have to start somewhere. And I think that's what this administration is trying to do. You start with the low-hanging fruit, and then maybe from there, you have some wiggle room to negotiate bigger things. And that's one part of it is spending, but the other part is revenue. How does the government get revenue? And that's taxing or potential tariffs. So if you throw the tariffs and maybe, the taxes come in line and maybe some of the sunsetting that we thought we might see, it doesn't happen. So I think those are two big points. You have to really remind ourselves how big our deficit has grown, especially with COVID. That's just balancing our books. And this is not something that, happens overnight. But I think what this administration is trying to do is using it as negotiation within our politicians to get us to a better place.
Yeah, the tariffs are definitely a tool, for getting people to the table. And as you saw by today, the rapid movement of the market after the announcement was a signal there. Alex, do you have any comments as well?
Yeah, I think without a doubt, the path of least resistance to reduce the deficit is going to be lower interest rates. It just has to happen. There's simply too much accumulated debt and deficit for the government to have rates as high as they are. So they will need to get rates down. And if and when that does happen, the Treasury is hopefully going to term out the debt, meaning instead of issuing Treasury bills and borrowing money over short time horizon, they'll lock in a low rate for a much longer time horizon to try to get interest expense down.
Let's talk a little bit about the corrections and where are we positioned? Where were we positioned at the beginning of the year, Joe, and where are we now?
Yeah, so I mean, some of the things that we had we did some cash raises in the beginning of the year and a little bit at the end of last year. But again, looking going forward, it's the sweet spot for us has been in the worldwide, and this is something that since the inauguration, you have to look back what was doing really well, and that was the U.S. markets and technology, full on risk on. And then you fast forward, maybe too much optimism came into that level and it needed a cooling off. Well, we got that at the beginning of this year with our markets cooling off. And the things that were sold off the most, that's international healthcare, actually have been holding their own as this year has gone on. So I think that's a resetting. These resettings are painful, but they're necessary. And that gives us a little bit more balance as we look forward to which companies. And again, I really think large cap has held its own. And as you've gone forward, that's the thing we have to look at. Companies that have pricing power. It's tough with the tariffs because you don't know where things are manufactured. But companies that have pricing power are the ones that are going to do well. And again, that's just something that we've continued to say, but owning good, solid companies, that's going to help you in times of uncertainty. And that helped us for sure.
Sure. We've been talking about the first quarter GDP numbers and whether or not we are either in a recession or we're going to show signs of it. And from kind of the rear view mirror positioning that we'll eventually see that information. Alex, do you want to comment on that?
Yeah, so Q1 GDP is going to be artificially low, and the reason for that is the tariff front running I mentioned earlier. The trade deficit reduces GDP. So when importers, try to import 4 months of goods all at once, that flows into GDP and it reduces it. We also had $20 billion worth of gold come in from Switzerland. That reduces GDP. So I think those things in particular will reduce Q1, but ultimately that will be reversible. And of course, that's not going to happen in Q2 because they're already stocked up.
And so the expectations going forward for the stock market, that's a good transition to that, Alex, and we can go off the historical information that Joe mentioned earlier. I'd like you to comment on that.
Oh yeah, so earnings are still projected to be strong. They really haven't been adjusted too much as a result of the tariffs. They're expected to hover around double-digit growth. That's probably too optimistic, but even if we only get half of that, 5% earnings growth is, a quite positive year. And everyone's now forgotten about it, but AI is, still happening. We're still getting these just massive capital expenditures being, done by the Apples, the Metas, the other hyperscalers, and that is extremely positive for earnings.
Joe, do you have any comments?
Yeah, and I think it's important to note when we say companies front running, they just imported more. So even though tariffs, might have been in effect or might go or whatever it may be, they have enough inventory to usually last them, 3 to 4 months. So even if we were having these high tariffs, it's going to take 3 to 4 months for us to really feel the pinch. And I think that's what we didn't see. And what we could see is, again, the consumer pulling back, and just getting prepared. If we were to see that, it's not going to be till the second quarter where we would see a pullback. And again, it's supply demand, simple supply demand. You don't have enough demand, then you have too much supply. So we're a little bit there. But I also, when you look at the ports, one great thing living in LA, we have the Port of Los Angeles and the Port of Long Beach. They have a record amount of container ships out there. And that's another thing that kind of reminds us of COVID, the flip side of that, where we have a lot of stockpiling out there. So those are good things that happen, but it's going to take some time for that to come through. As long as people are employed and spending, that's why we remain optimistic as well.
We shifted at the beginning of the year into more of a value strategy, Joe, and what do we see as the most opportunity for the sectors and potentially even some names that we like?
Yeah, what's interesting is we talk about what is defensive value. Now, defensive large cap has been the place that has held up. And why is that? Alex mentioned it. These companies are able to borrow at extremely low rates. And we've seen that on the bond side. They've all gone out and borrowed, and they have a ton of cash. One of the companies we do own is Broadcom, and this is technology. They just announced a massive buyback because they're flush with cash. And they're also did a couple of acquisitions that they're paying off faster than expected. That was one of the stocks that's up huge today. A little bit of the retailers as well. That was hard hit because why? Manufacturing. Most of retail manufacturing is done in Asia. And when you put those high tariffs, it just automatically balloons the cost of it. So that's kind of a big trade that just happened. So a few things like that we're going to pay attention to. We're also concerned with the consumer. If you do see that pullback, maybe those areas don't do so well. And if the government is spending, maybe some of the infrastructure rebuild, which does have bipartisan support, continues to do well. You heard a little bit about coal. We talked about energy and how much our infrastructure needs to be updated. So I think that'll continue. But the big one, and we mentioned this earlier, technology. That is something that is going to continue to happen. And anecdotally, we used to talk about a Zoom call, but now it's going outside and looking at how many driverless taxis are out there. Not only do you have Waymo, but Amazon's coming out with theirs. And I mention that because the number one job across the globe is a driver. That no longer can be the case. And this is globally. So what happens with that displaced workforce? That's something that's going to be interesting to see what transpires.
Alex, do you have any comment?
Yeah, I think, when you talk about something like driverless trucks, driverless cars, the effect is to grow the economic pie. And yes, it does create conflicts about the distribution of the pie, since you have a minority of people who lost their jobs, and obviously they need to be helped out. But for the economy as a whole, a robot truck is simply cheaper and better than a human truck. That reduces the cost of everything, since essentially everything is trucked to some extent. So, these innovations, while, they can create societal strife because people, lose their job, overall, they're very beneficial for the economy.
When we talk about the what's the most exciting thing about the next couple of quarters, or even tomorrow for that matter, as of what happened today, we've been reminding our clients, you as the audience, that Joe's point on there are 493 other stocks that have been participating in more of the broadening of the market, and the sectors that we are focused on for the next quarter, 2 quarters, and further out are kind of obvious. We've talked about technology and how important it is to have that as a sector, and Joe spoke of Broadcom's name in the Mag 7. We really like the industrial sector. Healthcare is still
Insurance.
insurance. Yeah, go ahead, Joe, take over.
Yeah, and you really think about, prior to this insurance, what if, and especially those that live in California, we know our premiums are going up, not just for health insurance, but for property insurance, and go through the whole gamut. We like companies, that when you see your price going up, own that company because they have pricing power. And that's what insurance companies have. No matter what transpires, they're raising prices. So that's a good area, to be in when you have this kind of uncertainty. And again, relating to tariffs, you try to have things that are, Chipotle is one of the growth area that we liked. And you kind of think about that, it's farms in a lot of their product is locally grown. So those are some areas that you can see companies not be as affected. It's also, we talk a little bit about, Tom mentioned the industrial. And again, we think the technology is still going. We mentioned data centers, and who knew Ohio is, one of the hotbeds for new data centers, and this is kind of a changing of the landscape from what used to be to what is now. And I think that is something that the rest of the world is going to focus in on. And that is a huge growth opportunity that continues to expand.
Yeah. Alex, anything?
Yeah, Joe sort of mentioned it, but in general, the reindustrialization beneficiaries, those companies that, and they're not all in the industrial sector, though many of them are, the companies that will benefit from onshoring and just an update of, the American industrial infrastructure, which is much, much needed, right? It's been decaying for 30 years, and there's a lot of space for it to regrow.
Yeah, we actually had a conversation about the GLP-1 drugs about a week ago. That is no longer the popular topic of the day, and they're a long-term growth driver with a massive market opportunity. And Alex has said this before, that 40% of Americans suffer from obesity, and the global demand for these drugs exceeds the current production capacity. And over time, these drugs are going to reshape healthcare spending and corporate earnings, and longer term consumer health trends. And once again, the memory of the media is very short, and it goes on to what the hot topic is. So there's opportunity there. Joe, what if we get clarity on the tax bill, the big tax bill?
Yeah, that's a big thing. Anyone that runs a company, it's hard when things are changing. You need to have some clarity, and I call it finality, where now these are the rules that I have to play by within this corridor. How do I navigate? And I think once we get that, and again, I think the way this administration has laid out, it's negotiating things to work out its best. But once we get the clarity, then we can move forward. How to navigate, what you need to do to be prepared. And I think that's that should be coming hopefully soon. And that'll help, not just companies, but us as households on where we're going to spend our budgets. That's a big thing to look at.
Alex, do you have any statistics that you'd like to share on that?
I guess say in general that will, of course, raise the deficit, though if we do get lower interest rates to offset it, that could do it as well.
Yep. So any type of structural improvement in the economic policies that are out there could, sustain the growth, and we could start a new multi-year cycle, business cycle of improvement and big gains, and that's what we've been talking about. But it's overshadowed by the enormous volatility that's in place, and so direction and leadership is key in the conversations that we have out there. And if this is, a transformative program that's taking shape right before our eyes, I'm welcoming it because we've seen multiple administrations going back decades that have tried to address this, but it just continues to be excessive spending out there, and now we've got to rein it in because the world has been kind of artificially created with stimulus, and we've talked about this amongst our group. You can't just keep pumping money into the system. Eventually, you have to rein it in. And now we're seeing strains with the size of the deficit, the percentage of GDP that's going to go towards paying down the deficit or the interest on the deficit. And there are only a couple ways you can address it. You've got to raise revenues, you've got to cut spending. Hopefully, you have a favorable interest rate market going down, and then, where are you going to raise revenues in other places, the tariffs? So maybe this is the time that we're going to see this reshaping of economic policy for the U.S. Joe, we've talked about the tariffs. We've talked about the deficit. We talked about what sectors we like, and the discipline from our outlook is to stay focused and just kind of let things settle down. But we have positioned people in a very strong light, and I'll let you conclude. What would you like to say?
Yeah, and it's sometimes like, when we say emotional, it's also our biases. One of the things that we did add to this year was something that some people may not like, but it's tobacco stocks. And this is a trend that anyone younger vaping, it's something different. And I mention that because that's the fun part of what we do, is looking at new trends that are coming out and how does this affect society. And that's really the fun part as we see this play out. But also, it's a reminder things are changing, and with technology, they're changing extremely fast. And that's where sometimes you might need to take a pause and let's really look at what's happening before you make a decision. And we welcome our clients giving us a call if anyone has different questions on how they're positioned, or if they have cash and don't know what to do with that. We can offer you some opportunities because, again, with each risk, there comes opportunity going forward. And you really have to have your mindset looking out because, again, technology doesn't go backwards. It's going to keep moving forward. And we have an administration that is trying to protect our intellectual capacity that we have here. And that's a big ask to see how that plays out. But again, what other country would you want to be in where you can profit off your own ideas when you have something that's, doing what we've done? And again, it's our markets, it's our technology that's been the last 10 years, the driving force around the world. And don't think that's going to end. That will continue.
You're right. Protect that intellectual property that we have out there that we've worked so hard to develop. Okay, well, this concludes our discussion today. I want to really thank everybody for taking the time to be with us today. Our call is recorded we will have notes for it that we will share with you shortly. If there are any follow-up questions for the group, we welcome a direct call to me, Joe, or Alex, or the team. But at this point, we hope that we have more positive news in the coming weeks, and that we reduce the amount of conflict that's out there and increase the transparency and the clarity that we see. I hope that you enjoy the next couple of days, because no telling what's going to happen tomorrow after what we saw today. Boy, that was incredible. So, all right, well, stay positive, everybody, and we will have another update in a couple of months, and if not sooner. Thank you very much for joining the call.
Thank you.